Oh, and just a bunch more popped up. Well, we'll get started and people can keep trickling in.
Yeah.
So everyone, thanks for joining. I'm Jordan Fry from the Prudent Plastic Surgeon. And I'm really excited. This is the second time Harry Zegarra is joining us. He's a practicing physician, but he also has a ton of experience with real estate investing, and I've picked his brain and learned a lot of stuff. He also is a syndicator, so not only does he invest in real estate himself, but he helps put deals together for other people. And what I've always appreciated about Harry, and why I keep asking him to do these, is he's really honest and straightforward about this stuff. And anyone who's in our Facebook group, there's been an interesting discussion going on kind of about syndications and sometimes when they don't go as planned. So with that sort of winding introduction, I'm excited to have Harry here, and he's going to talk to us about a bunch of different stuff, and sort of how he got into this as well, which is interesting because I know a lot of people are interested in how to become syndicators. So he's going to share with us a bunch of stuff. We want this to be really kind of, casual and informal, and anyone that has questions, feel free to, chime in and just sort of, put your speaker on and your camera on and ask us or ask Harry, and there will be definitely time for discussion at the end. So yes, Harry, thanks for joining us. I'll let you kind of take over from here.
All right, Jordan, thanks so much again for having me here. I appreciate the opportunity, and thank you everyone for being here, also, and sharing with me your time, precious time. So let me try to share my screen with you. I'm not sure if it's working. Can you see my screen? Oh, thank you. Okay. Does it look all right? I cannot hear you. You there?
Sorry. Yeah, looks good.
Okay, perfect. Yes. Sorry, guys. Okay, yes. So thank you again. So I'm Harry Zegarra. I'm a physician here in Dallas Fort Worth, pulmonary and critical care, still a full-time doctor. We have been here in Dallas for about 5 years already, and a little bit more with my wife and kids. So a little bit about us, is for you guys to know. So my wife and I, we both are physicians. Again, we're from South America. We're born and raised in Lima, Peru. That's where we went to do our medical school, and so we actually knew each other for the whole career, for 7 years before we start dating. So it's kind of like a story that I sometimes tell people. So Mitzi, my wife, and I, we have been married for 15 years, which is also the time that we have been here in the US. Have been very grateful and blessed that during all this time we actually got to live together. Despite we doing different residencies and fellowship, we never needed to split or anything like that. We have 2 boys, Leonardo and Lucas, 11 and 7 years old right now, which in this moment are on the 2nd floor. So I just send them upstairs, so we have some quiet time here. My wife, she's a family medicine doctor. I'm a pulmonary and critical care doctor, already in practice for 7 years, initially in private practice in South Texas, and again in the last 5 years here in Dallas. Right, as Jordan mentioned, we have been in real estate for about 5 years, even though we were very interested from way earlier than that. Because of the nature of our training and work, we were moving very often, every 2-3 years, as you can imagine. So we couldn't get started until we arrived to Dallas, and we decided to settle here. Initially in residential real estate, and then in the last 2 years, a little bit more than 2 years now, in commercial real estate or syndications. All right. So for this presentation, this is what we're going to touch. What you need to know to start investing in real estate syndications, the things that you can expect from when you invest in real estate syndications. And also, it's important always to talk the risks involved. I haven't touched that much on this presentation, but at the end we can go through some of your questions. So what you need to know to start investing in syndications, right? So like first, like as always, get started is like, what's a real estate syndication, right? Like, it's kind of like a fancy word, syndication, and even with many investors in real estate, single family homes, like short-term rentals, some of them, they haven't heard like the word syndication, right? Like, so, and it's actually something very simple, right? Like, it just means group investment, right? Like, so, as it says here, like a group of people joining forces and putting their money and also time and effort together to buy real estate assets that otherwise would be very difficult to acquire, right? Like, because we're talking about sometimes 100 units, 200 units, 300 units apartment complexes. And actually, as I always mentioned, like, so syndication doesn't necessarily mean just only for apartment complexes. I mean, you can do syndication for anything, right? Like, you can do syndication for a restaurant, for an airplane, or for different kind of business, right? But the main thing and the great thing about this is that it allows to leverage like your time and your money, and make other people who are experienced and who are doing this full time to work for you and your money. So why to invest, right? Like, so and especially in syndications, right? Like, so we know, like, I mean, it's very important in general, like, to try to get educated, to diversify, right? Like, but not everyone is inclined to do this actively, and not everyone is passionate or has the time to do it, right? So that's why, like, I mean, it's good for someone who, again, like, who maybe doesn't have the time, is not interested in doing like the active investing, right? Different to stocks or even crypto, right? Like, so when you buy or trade that, I mean, like, it's something that you have on your computer or something that is somewhere in a database. But I mean, it's not a physical asset like a house, like a small multifamily, or even like a large multifamily, right? The stability too, right? Like, so you go back like to 2008, even, like, right? Like, when we had like a big crash, even like the single family homes at some point got in trouble. Interestingly, multifamily and commercial real estate was the most stable around that time, right? Like, the default was in loans and all of that was less than 1%. We all understand like cash flow, right? Like I just recently like saw like in Jordan's so Facebook, that someone like plays like a small video like about like all the benefits of investing in real estate, right? Like, and cash flow is one of the most important ones, and sometimes it's like determinant of is if a deal makes sense or not. Tax benefits, right? Like, so, and we use that in single family houses, but also is even more exponential in commercial real estate, because you can do cost segregation studies and even bonus depreciation. That helps you to not necessarily avoid taxes, but to delay taxes, and that's one of the great things about real estate. You can use cash, but you can use different ways to invest, even with your retirement accounts, and that's something that many people has been doing that in the last, especially in the last 3 or 5 years, that we always say it has been like the golden ages of real estate, right? Like, but the key here is like the term self-managed, right? Like, so in this case, it's a self-managed IRA, self-managed 401k, right? And interestingly, I mean, like, and this is something that I have experienced firsthand also since last year, since about August, in one of the projects that we had. I'm part of the asset management team, so I can see myself, and I have seen firsthand like the difference that we can make in these communities, right? Like, so you also try to improve like the area where they live, where these people live, right? Like, so you spruce up like the buildings, you try like to make a better place for other people to live. So who can invest, right? Like, so in general, there are two types of offerings, right? Like, so one is like it's kind of like a technical term, 506B and 506C. So like the 506B is just mainly like for people who you know from before, who you have a relationship from before. And 506Cs are offerings where you don't need like you don't have to have a prior relationship with that person, but everyone investing in that offering needs to be an accredited investor. An accredited investor has like actually at least 5 or 6 different ways to qualify, but the most common is like the ones that I share here, right? Like to have at least $1 million in net worth, or like to have a good income as an individual or jointly, right? Like to have that in the prior 2 years and have a reasonable expectation to make that the same in the following year. So how it works, right? Like, so we have like a group of people working together that together they acquire a bigger asset, right? Like we have general partners and we have limited partners. The general partners are the ones who do mostly all the work, right? Like, so they are the one who do the analysis of the properties, and kind of similar as single family homes when you try to when you need to put like 20 offers or sometimes even more like to just get one property, is very similar in multifamily. So you sometimes need to do underwriting or analysis of 20, 50 or even more properties in order like to get one. You put like the team together, we do like the assessment of the property, and sometimes these properties are not like in our backyard, right? Like, so we need to travel to that area, we need to hire a third-party company to evaluate the buildings, right? We need to put the loan together. After closing, we need to do the asset management, like, which means like you oversee the property management company, like because you can just not leave like the property management company by itself, right? Like you need to make sure that they're doing their work, and at the end, like we do the refinance, or like at the end we sell the property. But of course we need the help of the limited partners, right? Like, because we're talking about millions of dollars, and sometimes when you need like the down payment to close on these properties, we're talking about 5, 10, 15 millions of dollars, right? Like, and even though like the general partners are like 5 or 6 sometimes, and still have some capital, some reserves, I mean, still has a lot of money for just a couple of people. So that's where we need like the help of investors, right? Like that want to maybe to diversify their portfolio and invest in real estate, and not necessarily being active in that field. What are the fees, right? Like, so it's fair like to know about this, right? Like, and this in general like is industry standard, right? Like, so in most of syndications that I have seen in the last 2-3 years, this is kind of similar, right? Like, and what are these fees? Like, because like the active partners, like the sponsors, they put a lot of time, they put a lot of effort, and they also put their own money in these projects, right? Like, so these are the three most common fees, right? Like the acquisition fees at the beginning when you close on the property, 1 to 3% of the asset price. Well, I mentioned before, asset management fees, right? Like, and this is like, I mean, of course, because you follow on the property and also on the property management company pretty much every week, right? Like, and you're also like as a physician, you're on call, right? Like, so if anything happens, like sometimes like there are still the decisions that need to be taken, and the property management company, they need to touch base with us, like in order like to take these decisions too. And at the end, at the end of the project, and at the end when we're going to sell the property, right? Like after we have paid like the cash flow or like the preferred return, there's usually a split, right? Like in the past, it has been like 80-20, 70-30, but lately in the last, again, 2 years, it's mostly 70-30. So what can you expect from investing in these kind of projects, right? So first, we need to talk about returns. I mean, of course, like as we always say, like in any investment, past performance is not something secure about like future performance, right? Like, and as any investment, it's important you to do your due diligence. And as in any investment, it's also important for you to know that, again, like you can make money, you can also and get like to what has been offered to you. You can even make more. You can even make less than that, or you can even lose your money because we're talking about an investment, right? So cash on cash returns, right? Like, so this is the cash flow or passive income, right? Like, so this is what we are left after from the rents and all the fees involved from the tenants, after we have paid, I mean, all the expenses, right? Like including like the property management company and debt service, and also like any repairs, right? Like, so, and usually has been like in the prior years, probably 3 to 5 years ago, I mean, we were having amazing cash on cash returns up to 10 or at some point. In the last couple of years, it has dropped a little bit more, like to around the 8. Just being totally honest and transparent with you guys, we probably will see in the next 1 or 2 years these to drop a little bit, like even more, right? Like to the range of 5 to 7 to 8%. The good thing about like syndication is like the way it's structured, and many times this is to protect the passive investor. So we have this what is called a preferred return. So which means like the first 5 or 7 or 8% of returns go exclusively and only to the passive investor, right? Like, so which means like, again, like at the end of the cycle, right? If for any reason we're not reaching the preferred return that we offer, like when we sell the property or when we are going to close and sell the property, before any split, we make sure that the passive investor had been paid first, these 5 to 8% per year, right? So then we have the split of profits, right? Like, and that happens also like, because like when you take over a property, when you manage more professionally like a property, right? Like, so you expect, and also with help of, again, like inflation and all of that, so you expect your NOI or net operating income to be increasing every year. And when this increases every year, the value of the property also increases. So at the end of the 5 or 6 years, so you would expect also to get an additional 40 to 60% more like of what you invested, right? Like, so which together, again, like putting that together, like the cash on cash returns and the split of profits make an annual average return of 15 to 20%. So, and there's the caveat here, right? Like, because many of us have heard about this in the last 2 or 3 years, amazing returns or IRR or things like that, that they were buying a property and selling in 2 or 3 years with doubling the money and all of that, right? That was like a very unique time, and that may not happen again, like for some time. So again, like we need to be more realistic about like our expectations on that. So I can kind of now to have more like a time limit of 5 or 6 years. What can you expect also when you invest in a syndication? Communications, right? And that's very, very important, right? Like, so you're going to get like monthly updates about how the property is going, about the renovations, about the occupancy, about any problems that may present, right? You also have quarterly financial updates. So kind of similar as the monthly updates, but a little bit more in detail about like how we financially are doing, the ins and outs, how are we are doing in comparison with the mortgage and debt service, right? So and quarterly distributions too. They usually start like between month 6 and month 12 in the last year, right? Like, so again, like in the last 2 to 3 years, there were some projects that were starting like the distributions even at month 3, at month 5. Now in the last couple of years, it has been a little bit more in the month 6 to month 12. With what is going on right now with the increase of rates and the Feds and maybe not that much increase in rents anymore as before, we may see even this a little bit more delayed, even like around month 12. Right. And also you can expect a yearly Schedule K1, right? Like at the time of taxes, right? And this is going to show like, again, like the income and expenses. And usually that's one of the things that investors are expecting, because it's going to show the depreciation of the property, right? Like, and even until 2022, we had like the possibility to have like the 100% bonus depreciation in the first year. Now we're down to 80%, but still it's really good. What are the risks involved when you invest in a syndication? It's kind of brief, like, but just like to mention again, like again, we have seen extremely great returns in the last 2 or 3 years, and because of a couple of factors, right? Like, so one was like the inflation or hyperinflation, right? Like, so everything was getting more expensive, including rents, including prices of properties. There was also like the compression of the cap rates, which also just with that just would make like a property or an asset more valued, or like the price would go up, right? Like so, but again, as I mentioned before, it's an investment, right? Like so, it's not a warranty. So and if for any reason you talk with an operator, a syndicator, and he or she tells you that they warranty you that you're gonna make that amount of money, run, like because again, it's an investment. You cannot guarantee that, right? And also, again, like in the next few years, in the next couple of months or years, execution is going to be very important, right? Like we have been very blessed in general in terms of investments in syndications in the last few years. Again, as I mentioned, like because even you didn't need to be a great operator, you didn't need to do that much in the property, and all the prices would go up just by themselves. Now, operations and asset management is going to be very, very important, right? That's something like to take in mind, and something that, for example, when you take with different operators or syndicators or someone that you may think investing with, right? Like you need to ask, like, who is your asset management or manager? How long has he or she been doing this? Is he or she doing this full time, right? Now, like a little bit more about like what's going to happen in the next couple of months or years. All right, we ready for this? So I mean, I always start like with, in order like to know what's going to happen, just try to go back and see how we got here, right? So what happened in the last 2 years? So COVID happened, right? Like so, it happened to probably all of us, right? Like that we're in the medical field. My wife is a primary care doctor. I'm a critical care doctor, so we all experienced that. So, but what really happened like with the rest of the people, right? Like so many people stay at home, right? So they didn't spend that much money, so they were not going to the movies, or they were not traveling, they were not going to restaurants, so they start accumulating money or wealth. Also, like the government pumped a lot of cash, too much cash, maybe, right? Like so, we also start seeing like the lots of supply chain problems, and finally, like the Ukraine war. So all of that, what made it happen? Transitory? No, I mean it was a real and uncontrolled hyperinflation, which in a sense for real estate investors, as we have these assets, and real estate goes together with inflation, and even more than inflation, it's a good thing for investors who have assets, right? But however, like in general for the economy, it's terrible. So what was the hyperinflation effect in real estate, coupled with very historically cheap interest rates or debt, right? So prices of every property went up. Single family homes, small multifamily, or big multifamily went up. Also rents went up. Historically, growth of rent over 10%, 10 to 15%. And the prices of the property, as I mentioned here, they went like in 2.5 years, 25 to 50% in some places. So what does the Fed do? They do what the only thing that they know to do, to start increasing rates, right? Like so they start increasing rates, and very aggressively, also historically, a very steep raise of these rates since March last year. Right, like so we have seen like the effect of this in some areas, some hot areas, like California, even in Phoenix, in Miami, the home prices started decreasing. But if you take into account how much they went up in the last 2 years, they are still very, very up, right? Like so they have, in some areas they have decreased 8 to 10%, I think, like in average, right? Like, but in average in the US, it's probably like a 5% only, right? But they're still really high compared to 2.5 years ago. Also, what happened, like the volume of multifamily transaction or commercial transactions drastically dropped 78%, despite the prices were not affected that much. And the prices were not affected also that much because the NOI, or net operating income, still was increasing, like because the rents were increasing, right? Like so we have seen like the increase of the rates are affecting operations in multifamily, right? Like now it's more difficult like to get debt. It's more difficult to put deals together, right? So like especially like and I was talking with Jordan, I mean, at some point a couple of weeks ago and saying like, yeah, I mean, like I hope or I expect like to have a new project in the next 4 to 6 weeks. That may not happen. Like it's still like there's a disconnection like between the expectations of the sellers and what we can really make work, right? So what with all of that, what could we expect like to happen this year in real estate, especially in multifamily? So I don't have a crystal ball, but I mean, just I mean, I've been attending different a number of meetups and webinars with other investors in the last 4 weeks, and we still believe like the number of deals are going to be low, at least for the first half of 2023 of this year. The Fed just increased actually like today, like another hike of 0.25, which actually was good news, like because we were like just wondering like between 0.50 and 0.25, and probably they're going to continue increasing rates 0.25 for another 2 or 3 times, and after that they probably going to continue at that level for hopefully 5 months or even less, and they're going to start like declining rates. All right. So just for you guys to be aware, like all of this is affecting operations. All of these will make like the cash flow to be delayed and sometimes and some occasions on hold, right? Like for which again, like these returns that we were seeing in the last couple of years were unsustainable, honestly, right? Like and probably people were used to those, but I mean, like we need to reset expectations, right? Like for the sellers in this moment who have like these properties and are expecting still like to get like a higher price, and even like for investors too, right? Like for me, for operators, and also like for passive investors. And as I mentioned before, it's very, very important now to focus on operations, right? That's going to make or break a deal. That's going to be like the main determinant in many of these projects, right? Like in the last, it's very, very important that I mention this again. In the last 2 or 3 years, you didn't need to be a great operator like to make like your syndication work, right? Still, like just with the inflation and just with the compression of cap rates, you were going to get a great like a return on investment. Now it's going to be different, right? So you got to be careful out there. The silver lining. So this is not necessarily good in general for the general people, but it's just for us to know. Like in the last 2 years, home affordability has dropped drastically, right? Like because like home prices, as I mentioned, increased to 25 to 50 like percent in some places. The mortgage also the mortgage is also increased, like the rates in the mortgage, right? Like so more than double that at the beginning. So again, like home affordability has dropped drastically. So rents have increased, but owning a home had increased even more. So still there's going to be people who are going to need to be renting because they cannot afford to buy a home. Rents, and also on the bright side, also rents will continue rising for investors. And the reason is like because also we're not having hyperinflation at 9.1 or more anymore. But still, our like inflation in December was 6.5, and probably like in January in this month is like around five something, right? So rents will continue rising, and this is and the last point is one of the most important too. There's a huge shortage of housing in the U.S., and this hasn't changed, and probably this is getting worse as we speak, right? Like so with what happened in 2008 2010, many builders, they didn't buy, they didn't build enough homes, and
okay,
the same
5 minutes is up. Let's put this away. 5 minutes.
All right. And so there's still a lot of shortage of housing in the US. So which means like people's not going to be able like to afford homes, and more people is going to be renting. And with that, this is just like what I share, like my website, and also more importantly, I mean, as passionate as I am in real estate, I'm also very into education and try like to find other ways like to invest in real estate. And I'm a firm believer like to invest in something, you need to get to know or get educated in that, so you feel comfortable in that and know your options. right? And this is also one of my favorite guys. Knowledge is not power. Knowledge is only potential power. Action is power. And with that, I think we're good.
No, that was great. Thanks, Harry. As always, like it's very refreshing to hear your take on everything. So I think there's already a few questions in the chat box, so I'll just kind of jump to those, and then anyone who has additional questions, just either type them in the chat box or just unmute yourself and ask away. So first is from MP. He says, what do you think about President Biden's plan to do nationwide rent control? So what are your thoughts on that and its, potential impact?
Yes. So there's specific places that we know, right? Like California or New York that they're doing that already, and they have them for years. And the usual idea is that controls the rent. Like I think that hasn't been proven or proved, right? Like, and also this is a more local thing, right? Like, so we have that in California, New York, like because of the specific government in those areas. It's going to be very difficult that to happen. Or get together like Republicans and Democrats like to do that. But yeah, I mean, it's something that we need to follow closely. But it's something that the other thing is that many politicians, they also own real estate. So it's going to be kind of like an interesting battle to see in Congress. But they time and time they bring that topic, but I haven't really heard that's going to change anything, like at least in the short term.
Yeah, it's interesting. Oh, go ahead with someone.
Yeah, I'm sorry. Can I make a comment on that? This is Dr. Sanjay Sharma. I'm a syndicator in Southern California, and my properties are in Southern California. And I just kind of want to follow up on that question. So for us down here, the rent control is the norm for us. Like you said, is for years and years and years. Low cap costs are kind of the norm for us, and kind of makes our market unique. And we feel that those who invest in here, we're either whether we got tough skin or we kind of know the market. So I'm really curious that if in my market we all niche out, do you see if we do have nationwide rent control, which I don't like, but if you do see it, can you recognize opportunities where it would work well?
Yes. No, I haven't really got that information about that, right? Like, so, and mainly like because my like our teams or with my partners, we mainly invest in other types of states, right? Like, so we haven't faced that.
Well, how do you, Sanjay, because you're currently in that, and you said your properties are there. How are you sort of accounting for that?
Well, I mean, we account for it is it's in our underwriting. We don't we just underwrite conservatively in terms of what we're going to see in rent growth, whether it's 2%, 3%. But at the same time, our cap costs are so low, where we'll buy a 3 cap or a 4 cap, knowing that, when we make it a more efficient property, when we bring up in a way, the value of them goes up so dramatically.
Yeah.
So I think that's how we compensate with it, just because our properties are so valuable, and like what you were talking about earlier, the shortages are immense. I mean, in the C-class properties, for me in LA, I know I'll have 0 vacancies. I know there'll be thousands of people who want that unit.
Mm-hmm. Yes. And
but
also
what I don't know is what's going to happen to the rest of the country.
Yeah, that's very important. Like because you have different types of underwriting and different types of investors, right? Like on one side, you would expect maybe a little bit more cash flow. On the other side, with more like of the rent control, you expect more appreciation, right? Like, so, I mean, you just need to adjust your underwriting and your expectations for that.
Yeah, and I think that kind of ties in a bit to the next question, which I think is sort of the the crux, which, because essentially when you break it down, a syndication is you're taking your money, you're handing it to someone that doesn't have like a fiduciary or sort of like a Hippocratic requirement to actually make you money, to make it a good investment. You just really have to trust this person and what they're doing. And so the question then comes, well, how do you do that due diligence, et cetera? So, I think afterwards, maybe we'll talk a little bit more about underwriting, specifically for people who may not be familiar, like what that means and sort of very in broad terms how you do it. But first, John is asking, how do you successfully vet the management team to make sure they'll run operations efficiently and protect your investment? And that's even on a much smaller scale. I can say how that's so important because currently my wife and I, we just manage our own properties, which we have 17 units, all in duplexes and triplexes. And we know, just because we're involved and we're really efficient running them, that, our cash flow is so much greater. Our cash on cash is so much greater than other property management companies who are doing it. And then with syndications, that's on just such a bigger scale, to where every little efficiency in terms of cost savings or whatever it will be is just magnified. So
yes,
vetting in terms of efficient operations to protect your investment.
Yes. So yes, so as you're saying, nobody is gonna take better care of your money than yourself, right? Like, and nobody's gonna work harder, for example, in a property than yourself, right? Like, but there's a couple of things that now I'm very careful with any operator that we meet and we may partner like in the future, right? Like, so again, like we try to look for like an operator or a management team that has been together for 5 years at least, right? Like, and not just in the last 2 or 3 years, like an operator who also is doing this full time, right? Like, so for example, like in my case, so I'm an operator, I'm a syndicator, but I don't do specifically the asset management part, right? Like because I'm a full-time doctor or physician, right? And the other thing is also make sure like the operator or asset management person is close to the property or is able like to travel at least a couple of times a year, like to oversee like the renovations, right? Like, and there's also some operators who do GP calls like in a regular basis, like not necessarily with all like the investors, but with the GP or the general partners, right? Like which is a good thing. So everyone knows like more in deep or more in detail, like how the management or the operations are going.
Yeah, I think that's important and it's probably how you vet that out is tricky because it's trusting someone.
Yes.
And that's always something that's difficult. So I think you're always looking for someone who's speaking to you and is giving you the full picture. It's the same, like, I guess, any sort of treatment as physicians that are giving. You have to give all the risks, you have to give all the benefits, you have to give a rounded picture. If you ever tell anyone, like, I'm a surgeon, if I ever say like, oh yeah, it's just going to go totally smoothly, like that's just not true. So yeah, that's
Absolutely.
sort of
yes.
that
Yeah,
part.
yeah, and another part that I do, like many indicators or operators actually do, is also when we present a project, we also, I mean, there's also a requirement from many lenders that at least 10% of the capital raise comes from the GP or from the general partners. So you see, and also that they have a skin in the game and they have also put in like their own investment there in the property. So that's another thing, like, so probably some people can ask when they meet a new operator.
And then so, Harry, talk a little bit about underwriting, what that is, what that process encompasses, how you go about it. Certainly anyone else with experience, feel free to chime in as well, because I think it's helpful to hear how people tackle that.
Yes, that's one of the most difficult parts in terms of in terms of assumptions, right? Because like in the underwriting is just basically like spreadsheets in Excel, and you put different data there, like again, like about like how the rents, you get the help actually from a property management company, or actually two or three property management companies like to help you with the projections, or things like that. And you put that together with your assumptions also about how the property is going to be managed, right? Like, so for example, you expect like the physical vacancy to be 10% in the first year, in the second year, 8%, or the economic vacancy to be 10 or 5% in the second year. Also, what are your expectations about how the cap rates are going to change in the next couple of years? What are your expectations on how the rents are going to increase, right? Like, so, and this can change from operator to operator, right? Like, and that's why sometimes it's very difficult even for people who raise capital, and also for people who does underwriting, like to get together like and agree with a pro forma, right? Like, but again, like we get the help of 2 or 3 property management companies, and with that we are able like to get like a full scope of what's our business plan, right? Like, so a couple of things that I usually recommend like to people like to look at, or like to ask like someone who is presenting you a deal or a project is, so for example, what is the cap rate now, and what's the cap rate when you are assuming you're going to sell the property, right? Like, so you always need to assume that the cap rate is going to be worse. And now actually, like in the last 6 months, it has been getting actually worse. Like in the last 3 years, like the cap rates were compressing actually, and they were in like the opposite way. So that's why everyone was making so much money, right? Like, but in this case, and we expect that in the next couple of years, the cap rates are going to increase. So which means like the value of the properties are going to go down, right? Like, so also some things like to ask like the person who's presenting your project is, how's the expectation of the rent increases, right? Like, so again, like we have seen in the last 1 or 2 years, rent increases over 10% every year. That's not going to happen again probably in the next 2 years. So they need to adjust that expectation. And also like when you ask like the syndicator or the operator, like to ask that honest question, and to have that. Also, so one of the things is again, like what is like the interest rate that you're going in, and the interest rate that if you have a refinance, which no one is doing like refinance around like this time, what was going to be, right? Like, so there are a couple of things like that where you can ask like the operator, so this kind of question, right? Like, but again, like for someone, and just being honest, right? Like, so for someone who is not doing this day to day, it may be very difficult to fully understand or actually do an audit of like the numbers or the underwriting, right? Like, I mean, it's more like a trust process.
Yeah, absolutely. Any other questions that anyone has? Again, feel free to unmute or throw it in the chat. Can you talk a little bit, Harry, just about like how did you become a syndicator? Like how did you kind of, transform from just a real estate investor yourself to then working on these bigger ones? There's always a lot of people that ask me, how can I do that? Or, I know from learning about it that it's not easy, but it kind of seems a little bit easy. Like, oh yeah, I'll just collect money from all my friends and then, do it that way.
It's
talk a little bit about
easier
that.
said than that.
Yeah.
Easier said than that. Yes. So like there are different ways to become like because as you can understand, like a syndication process has so many moving parts, right? Like you have like the guy who does the underwriting or the valuation and also closes on the property. You have someone else to help with the capital raise. You have someone else to help with the asset management, right? Like, so, and it takes time, right? Like, so, and most of us have full-time jobs, right? Like, so, I would be, or any physician who is involved in this will be doing a disservice to his or her investors if he or she would be only a solo act, right? Like in my case, I partner up with other operators who have been around for some time already, right? Like, so they have like the expertise. And one of the important things like for me is like that they are doing this full time, and they have been doing this for a long time too, right? Like so. So how do you start? So one of the things is like like education, right? Like so like before starting like doing this, it took me like 3 to 6 months, like at least, like to get very comfortable with the process and actually going to meetups or going to conferences, and then start to doing some networking with investors or with operators, and they to get to know you, right? Like because when you are trying to start in this and you say that you're a physician or a lawyer or a professional, right? They may not take you seriously, right? Like because they know that you have like a full-time job already, right? It's just like when you are consistent there and showing your professionalism or your effort or your time there, is that when they start talking more to you and being more open for that, right? And then there's someone who, like at the beginning, he was telling me, like, if you want to be a syndicator, an active investor in this, you need to have one of these three things, right? Like you need to have time, or you need to have a good network of people, or you need to have some capital or money, right? Like, so I didn't have time when I started, like, because like I'm a full-time doctor, and I was doing single family houses and long-term rentals. I had a network of friends, family, colleagues, right? Like, but like I have some capital. So like I actually, like the way I started actually, and that many people actually start, and it's probably the safest way to some degree, is to join a mastermind or a mentorship, right? Like where you have someone who can take you along the way, who has done this before, and who can help you to and prevent to commit mistakes that, if you think about, like in multifamily, they are very expensive mistakes if you make them, right? Like so that's a way, like, to do it.
Yeah, I think that's helpful to hear and to understand. So we have a few minutes left. Any other questions from anyone for Harry about real estate investing, the upcoming sort of environment, becoming a syndicator, really anything? And if not, then we'll just wrap up a couple minutes early.
Yep.
All right. Well, thanks so much again, Harry. It's always great when you join us, and I definitely learn something new every time. Again, just really quickly, for anyone who's interested in following you or getting in touch with you, what's the best way?
Yes, thank you. So yeah, you guys have seen, like, my website, Nima Equity, right? Like, I'm an investor in multifamily, but also in single family homes. I still own them. I like and actually when I talk like with people, I always being very honest about this, that I think either single family homes or multifamily is a great way to invest in real estate. I mean, I never say like, oh no, you need to invest in syndications and not in single families. Like I think both are great ways to invest in real estate, and if you have the time and effort, why not, right?
Yeah, and I know, Christine, I think you may have signed out and then rejoined. You just asked, do you have the steps for becoming a syndicator? So Harry had just kind of talked about that. And I'll send out the recording of this as soon as we're done, so you can see that. And then Harry, John just had another question. Can you explain the tax benefit with syndications compared to single family home or small multifamily investing?
Yes. So with single family homes, like we know that we have like the depreciation part, right? Like which where you can like do the depreciation of the house itself, not of the land, over 27 years. So because of that part, or most of your cash flow, like when you invest in single family homes, are not taxed, which doesn't mean that you save on taxes. You just keep deferring taxes, right? Like, so in multifamily, it's kind of similar, right? Like, so, but it also has the benefit of doing like these three things: depreciation, cost segregation, and bonus depreciation, right? Like the depreciation is very similar as single family homes. Cost segregation is mainly an engineering study done by engineers and also tax experts, right? Where they allow to depreciate parts of the building or the apartment complex more rapidly, right? Like in 15, even in 5 years, right? Like to the point that they're able like to do this depreciation way faster, right? Like, and this is more, has more effect in people who have been investing for a long time, or people who have invested a lot of money where their cash flow is already very important, right? Like, so these are things like that we use, and we get the benefits when we invest in syndications. Something very important that I always mention about these tax benefits, right? Like, is that many people think like, okay, yeah, I mean, I'm going to get like the cash flow and it's going to be free of taxes and all of that. It's great, right? It's not necessarily like that, right? Like, so just being transparent about that, right? Like, so you don't pay the taxes on the cash flow when you own the property, right? But at the time when you sell the property, you have two types of taxes, right? So one is like the depreciation recapture, and the other one is the capital gains, right? Like, still, even if you pay the taxes of all of that at that point, the tax rate is going to be less than if you would pay in like the same year, right? It's around like 20% or something like that, right? Like, so so that's important. So it's because of that also when I talk with investors or people who are interested in this, is that you have to have a plan for when you're about like to finish like the cycle of this property, right? Like, so let's say you invested in a syndication and you're already in your 4th or 5th year and you're about to sell the property. You need to start talking with your tax advisor or your CPA about what you're going to do with that money that you're going to receive at the end of the syndication, right? Like, so you want to take that money out and pay like the taxes, it's fine, right? Or you want to take out the money and buy like a single family home or a short-term rental, and in that case you may be able to save more on taxes, or you may be able like to roll that money or that investment into another syndication, right? So there are options, right? Like, but it's something like, as anything in life, you have to be prepared and you need to be planned for that.
Yeah, and I think the important point is, whether, regardless of whether you're doing, you know, single family home investing or large multifamily through a syndication, the paper losses or depreciation losses and tax benefits, they're passive unless you have real estate professional status, which investing alone through syndications you won't get, because it's a passive investment, and that's sort of the trade-off.
Yes.
But you can use those to offset passive gains, which could be from selling, you know, from that depreciation recapture, or capital gains from selling a different syndication. So there's different ways you can play it. So certainly tax benefits, it's just understanding which ones are applicable and kind of how to best use them. Like Harry was saying. Yeah.
Yep.
All right. So thanks everyone for joining us. Thanks, Harry, for your expertise as well. Like I said, I will, as soon as the recording uploads, I'll send it out to everyone. And if you have any questions for myself, you know how to get in touch, or for Harry, you can visit his site. So thank you all for joining us.
Thank you, guys.